You're listening to Capital Topics, episode number 73. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the hedge fund industry with Raymond Kerzerho, PWL's senior researcher. Enjoy! Hello, James. How are you today?
I'm very good, François. And how are you?
I'm fine, thank you. Hello to you, Ray. Welcome back to the podcast. We're pleased to have you with us today.
It's my pleasure to be here.
Okay, great. So we've invited Raymond to join the podcast today because he has recently published a series of articles covering the hedge fund industry, and we thought that it would be of interest to have him on the show to cover the main findings of his research. If our listeners are interested in reading Raymond's articles and perhaps gain further insight into that industry, the articles are available on the PWL Capital website in the Learn section, and we will make sure to provide links to the articles with this podcast for easy access. So Ray, let's start with our discussion today with a basic question. The term hedge fund is widely used, but what exactly is a hedge fund for our listeners?
Yeah, hedge funds are quite particular. They share a series of characteristics. First and foremost, they involve complex financial strategies using a combination of short sales, derivative products, and or leverage.
Ray, so, I'll just stop you here. For our listeners, can you explain what is a short sale?
Yeah, a short sale is simply like selling a stock that you don't own in the hope of making money if it goes down in price.
Okay, so it's the opposite of buying a stock in the hope it's going to go up.
Exactly. So there's these complex strategies. There's also, so one thing that's important to understand about hedge funds is that it's difficult to generalize about them. Some of them are extremely volatile, and some others are very conservative, and they provide bond-like expected returns. Another thing that is common to most hedge funds is that they have a complex fee structure, usually involving a combination of base and performance fees. Another thing is their opaqueness. Usually, hedge funds are very reluctant to divulge anything about their investment strategies, or at least to divulge some details about their investment strategies. Usually, they say it's competitive intelligence, so they don't want their competitors to know what they're doing. And the last thing I would say is that in the case of individual investors, usually most hedge funds are sold to accredited investors.
Ray, I'd like to take a moment for our listeners here to help them understand what is an accredited investor. It's actually a part of the securities regulations in Canada. For instance, the Ontario Securities Commission Rule 45-501 exempt distributions spells out in its definitions on page 1 what an accredited investor means. And there's 27 different types of accredited investors, but two types apply to individual investors. So the first is an individual who beneficially owns, or together with a spouse beneficially owns, financial assets having an aggregate realizable value that before taxes but net of any related liabilities exceeds $1 million. An individual, so the second one, is an individual whose net income before taxes exceeded $200,000 in each of the 2 most recent years, and whose net income before taxes combined with that of a spouse exceeded $300,000 in each of those years. So, and again, it's very technical, but it really assumes that because you have that high income or those high assets, that you're a sophisticated investor, for whatever that means.
Right.
So, Ray, I got a second question for you about hedge funds. For most of our listeners, the hedge fund industry really is a mystery. Again, like you said, you know, it's difficult to generalize about them. But could you give us a high-level summary of the type of hedge funds and their strategies?
Yes, of course. So one thing that's important to understand is that there's literally dozens of strategies that are utilized by hedge funds. However, most, if not all, of these strategies can be grouped into three categories. So the first category is relative value. So basically what a relative value strategy is a strategy that combines long and short positions in highly correlated stocks. I'll give you a very simple example. I buy shares of Royal Bank, but I will sell shares of another bank, let's say the TD. So that would be a relative strategy, relative value strategy.
So you're selling short the TD Bank, right?
Selling short, yes. Absolutely.
Okay.
So these are two bank stocks, so they tend to move in concert. So by being long one and short the other one, it tends to kind of hedge your risk, if you will.
Okay.
I would like to mention that this type of strategy, somehow we tend to feel more secure about it because we're hedged. But many of the worst disasters in the hedge fund industry occurred due to relative value funds. Namely, one of them is probably the most famous failure, the long-term capital management, which failed in 1998 due to a position in Russian debt. And the hedge so the short position they had to hedge it did not work properly. And the other example that I can give is really the failure of U.S. Bank Bear Stearns in 2008. So relative value hedge fund strategies, they may appear to be less risky than they really are. A couple more, not strategies, but categories of strategies are event-driven. So an event-driven strategy is really a strategy that tries to take advantage of an event. For example, a merger announcement. So if there's a merger announcement, typically a hedge fund will take a long position in the stock of the company that is being acquired and a short position in the stock of the acquirer and try to take advantage of the mispricing between these two stocks. Mm-hmm. So this is another type. And the last type is really a directional. I'm taking a directional bet on a stock. It could be on interest rates. It could be on a commodity, on a currency. I'm simply taking a bet. That's another type of hedge fund. Clearly, the most famous so-called directional hedge fund manager was George Soros, who actually made a spectacular gain on by shorting or taking a short position on the British pound in the early 90s, making $1 billion in the process. Wow. Mm. Another example before we move to something else of directional bet, much more recent actually, is the people or the hedge funds who shorted, and also I'm sure a bunch of hedge funds were also long in the GameStop mania of 2021. So the stock was very volatile in these days. A lot of hedge funds initially were taking a bet that the company would go bankrupt, but some other speculators and retail investors started buying the stock. So the stocks was very volatile on the upside and on the downside. So that's another good example, I guess.
So, Ray, for our next questions, we're under the impression that there is very little transparency with hedge fund investments, and their strategies are complex to understand for most individual investors. What are your thoughts on this?
Yes, of course. Well, the thing is, before investing, it is paramount to understand the contractual terms of the product. First of all, there's the fee structure. And I'll tell you more about that later. Mm-hmm. There's a continuous investor info. So once you're invested with the hedge fund, you want to know in advance what kind of information they're going to provide to you.
Right.
so that there's not going to be some bad surprises. And then the other thing that you have to look at is really the lockup period. So this is important. So usually when you invest with hedge funds, in many instances you have a lockup period where you cannot withdraw your funds for the first 3 years. So that's another thing that you should look at very closely. And the other thing I would check also for those who are considering investing with hedge funds is really to check the reputation of the manager. I'll give you an example. Recently, the Wall Street Journal published a story about a $2 billion hedge fund who found tricks to avoid returning money to shareholders, despite advertising very high returns. So I don't know what the problem was, but he wouldn't return all the money to investors when they ask for a redemption.
Interesting.
Ray, in your blogs, you write about the promises that hedge funds make to their investors. Can you elaborate for our listeners?
Yeah, of course. So in general, hedge funds, they promise either two things or the both. They promise either high returns or uncorrelated return. So uncorrelated simply means that it adds diversification to your portfolio of stocks and bonds. So in my research, what I've seen in the literature is that the best hedge funds, they do have skill. They're able to generate excess return. The evidence about diversification is mixed, but in general, they can add diversification as well. But there's really no point in investing with skill if you have and having diversification if the fees are killing the returns. And that's really the problem. The problem is not that the best hedge funds do not generate excess return, is that the fees are absorbing a lot of these excess returns, if not most.
So before fees, they generate quite a bit of returns, but after fees, the fees is killing everything for the investor. Is that
the best hedge funds do, yes. The best,
okay.
Not the average hedge fund. That's another thing. You cannot just pick a bunch of hedge funds and expect you're going to make money out of it and get the diversification benefits. You've got to be really, really skilled in your how you can choose hedge funds.
Okay. Most investors have a good understanding of how the bond and stock markets are regulated. Mutual fund and exchange-traded fund ETFs are also highly regulated to protect investors. Can you help us better understand how the hedge fund industry is regulated?
Well, I'm not an expert on regulation, so I cannot get in the details of that. But one thing that I understand is that hedge funds have a lot of discretion about what they what they have to disclose and what they do not have to disclose. So they can disclose pretty much what they want. And in general, they're very reluctant actually to disclose what they're doing in portfolios. So what we have here is really a combination of opacity and high fees. And combined, I believe it's really a problem.
Well, Ray, a lot's being written about hedge funds, private equity funds, and other alternative investments. So, the message that they have high fees is well known. But can you share some facts about hedge fund fees and really how, at a very granular level, they impact the returns?
Yeah, absolutely, James. So what listeners need to know is really that hedge fund fees are quite subtle. And there's also impacts that could be unexpected from holding several hedge funds. In fact, there's a research that demonstrates that holding several hedge funds amplifies the impact of performance fees. I'll give you a simple example. So the idea here, let's say you hold a portfolio of 2 hedge funds. One is very successful and generate high returns, and the other one loses a lot of money. So the profits and losses of these two hedge funds offset one another. The problem is the successful hedge fund is going to charge you performance fees, but at the end of the day, since the profits and losses of the two funds offset one another, you're not even making money. So the performance fees, once you combine a lot of hedge funds together, they tend to cost a lot more than what is advertised in the legal documentation. And the paper I was talking about, actually, in the end, they find that on a diversified portfolio of hedge funds, managers may go away with as much as 64% of the gross profits.
Wow, that's huge.
That's huge.
Terrible.
Yeah. A few more points that are important to understand. The contractual terms in most hedge funds, I consider, to me, they're quite brutal. For example, 86%, so the vast majority of hedge funds, do not have a contractual hurdle rate for performance fees.
Can you explain a bit what's the hurdle rate?
Yeah, absolutely. So the hurdle rate is really, let's say I invest with a hedge fund. What they're telling me is, okay, I'm going to receive a base fee, so let's say 2% of assets, but also I'm going to receive 20% of the profits on the hedge funds. But you need to calculate the profits. And in the early days of hedge funds, you needed to have a return beyond a certain hurdle rate. So what it was saying is that whatever value you generate in excess of the T-bill rate of return, then you can calculate a 20% of that. But like in the vast, almost 90% of hedge funds, they don't have a hurdle rate, which means basically as soon as the hedge fund covers its base fees, it starts charging performance fees.
Oh, that's wild.
Yeah, that's wild because there's not much merit in beating zero, right? That's basically they're beating their base fees. To me, that's a bit scandalous. Couple more. Sometimes hedge funds collect performance fees if the fund performs well in the beginning. So that's the idea. You have very high returns in the early days, but afterwards the returns falters and become negative. Then it's possible that over many, many years, you're going to pay performance fees, but you don't really get performance because, yes, you've got a performance for a couple of years, but you've lost all those gains in follow-up years, right? Because performance fees, they're not refundable because the fund underperforms in the follow-up years. Once you pay the performance fees, they're gone. Forget about it. A last point I'd like to bring is that a major problem beyond high fees is the fee structure. So that's it. Most hedge funds have no hurdle rate and may not even have a high water mark.
Okay, what's a high water mark here? Right.
Yeah, a high water mark is another feature that we see regularly in hedge funds. So the majority of hedge funds have it, but not like 1/3 of hedge funds don't even have it. So a high water mark, what does it say? It sets a limit. It sets the level of the fund net asset value beyond which the hedge fund is allowed to pay performance fees. Okay, let's take example. I invest in a hedge fund, and in the first year, it loses 10%. And in the second year, it gains the equivalent of what it has lost in the first year. I won't pay a performance fee because I haven't gone beyond the high water mark, right? I'm still at the same level I was at the time I invested in the fund. So and this high water mark goes up as the hedge fund creates value. So really, the high water mark, in principle, it's a measure that is there to protect investors, but in reality, it's not hugely effective, I would say.
Okay.
Well, I guess this is why Warren Buffett always, talks about how Wall Street manages to extricate fees out of investors, and it's not to their benefit. And I mean, it's really scandalous how the regulation allows this to happen. And that's why in the U.S. in particular, there's so many multi-billionaires that are hedge fund managers because they make all these fees. I guess it's a nice business if you can get it. But again, for the individual investor, our listeners, sounds like, you're flipping a coin, and heads, the hedge fund manager win, and tails, you lose. So it's like lose-lose proposition.
Yeah.
So, but let's get back to, the institutional world as opposed to retail investors. So Ray, is there any evidence that large institutional investors have developed a methodology where they can best pick hedge fund managers?
No, I haven't seen evidence of that. Maybe it exists, but I haven't seen it. I can mention that CalPERS, the huge California pension fund, has exited hedge funds many years ago, and I've read what they have published, the press release at the time, and they justified their decision. Basically, they say that the opacity and the complexity weren't worth the results they were getting in return. So that's a good example, I think. The other thing I can mention is there's no persistence in returns. So the fact that a hedge fund has performed well in the past doesn't tell you anything about whether it's going to perform well in the future. Mm-hmm. And overall, I did not see any evidence of skill, really.
Yeah. So to conclude, Ray, I've got a last question here. Our wealthy clients are highly solicited by groups trying to sell them alternative investments. This is especially true with clients in private banking at large banks. The so-called advisors tell clients that they will increase the returns on their portfolio, all the while reducing the overall volatility. What do you think? Do hedge funds have a place in investors' portfolios?
Well, François, the first thing I could say is really when you're talking about an advisor working for the product manufacturer, I wouldn't call that an advisor. I would call that salespeople, really. Okay. So me personally, I never take advice from salespeople. It's not a good idea in general. I think if you're not a multi-billion-dollar institution, the chances of improving your financial outcome are really very close to zero. And hedge funds are very opaque, and it really opens the possibility that investors will be taken advantage of because they don't have all the information to supervise what's going on with their investment.
Well, again, the due diligence on just investing in one fund is incredible. You got all the legal documents, and then you got the financial analysis. Then, you don't know what you don't know because it's opaque. So it's what we call a black box.
It is. So on that note, we'll conclude. So thank you, Ray, for your participation today. I sure learned a lot, and I hope our listeners have found this topic of interest for them.
My pleasure, François.
I remind our listener that Raymond's series of articles can be found on the PWL Capital website in the Learn section. Also, thank you to you, James, for your contribution again today.
My pleasure, François.
So that's it for episode number 73 of Capital Topics. Don't forget, if you'd like to submit a question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your asset, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in. And please join us for our next episode to be released on April 16th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.